Episode Hook. President Trump just called his own China tariffs not sustainable, yet global markets are moving as if the trade war is heating up again. What's really happening? And how could this impact your portfolio, from auto stocks to rare earth suppliers? Number 1. Setting the stage. The trade tension returns. The trade narrative that shaped markets in 2018 to 2019 is back, only this time it's sharper and more complex. On Friday, President Donald Trump told Fox Business that the high tariff levels threatened on Chinese goods were not sustainable. It's probably not sustainable. You know, it could stand, but they forced me to do that, Trump said. These comments came after weeks of tit-for-tat measures between Washington and Beijing. China had imposed export controls on rare earth materials, minerals vital for everything from EV batteries to fighter jets. The U.S. retaliated with threats of 100% tariffs on Chinese imports starting November 1. However, Trump's acknowledgement that these levels can't last forever signals potential room for negotiation. Treasury Secretary Scott Bessent confirmed the two sides might extend the current 90-day tariff pause, and Trump is expected to meet Chinese President Xi Jinping later this month. Still, investors shouldn't mistake talk for détente. Both economies are testing leverage points, and global markets are already pricing in uncertainty. Number 2. Rare earths, real consequences. Beijing's new export restrictions on rare earths, critical inputs in semiconductors, EVs, and renewable energy have triggered global concern. The biggest risk is that the Chinese government overplays its hand, warned Christopher Beddor of Gavalka Dragonomics. By limiting supply, China could hurt not only the U.S., but also its allies and customers. Japan, Germany, and Australia have all called for coordinated action to secure alternative mineral supply chains. Treasury Secretary Bessent hinted at a potential coalition of democracies to counter Beijing's dominance in rare earth processing. For investors, that could mean renewed attention on non-Chinese rare earth producers like Lynas Rare Earths and MP Materials. Both stocks have surged in similar geopolitical flare-ups. Number 3. The economic fallout. Who really pays? Despite Trump's claims that tariffs punish China, Goldman Sachs estimates that more than half of the tariff costs fall on American consumers. U.S. importers often pass duties directly into higher prices for goods, from furniture to electronics. And it's already showing up in the numbers. According to Treasury data, U.S. customs receipts hit a record $195 billion in the 2025 fiscal year, up $118 billion from the prior year. That helped trim the federal deficit by 2% to $1.775 trillion. But the relief is cosmetic. While tariff revenue rose, so did spending, keeping the fiscal gap among the highest in U.S. history. Tariffs might balance the books in the short term, but over time, they weigh on consumer demand, industrial output, and small business margins. Number 4. Market reactions. Autos up, retailers down. The auto sector received a rare bit of good news. Following months of lobbying, the White House is expected to extend tariff relief for U.S. automakers by 5 years, allowing them to reduce duties on imported car parts. This is a major win for Ford and GM, both of which face rising input costs from steel and aluminum tariffs. However, retailers are feeling the opposite effect. Dollar Tree, which relies heavily on imported goods, said tariffs remain a problem despite stronger foot traffic. The company projects earnings per share to grow by up to 10% annually, but admits that higher import costs could offset much of that progress. In short, tariffs may favor some industries, but create drag elsewhere, a pattern investors must track closely when positioning sector bets. Number 5. Trade diplomacy meets corporate strategy. Even as governments spar, corporations are quietly hedging. Pfizer CEO Albert Bourla recently urged closer U.S.-China cooperation in pharma research, noting that China now accounts for 30% of global drug development. Meanwhile, Trump struck a deal with Germany's Merck KGaA to lower IVF drug prices in exchange for tariff relief. Under the agreement, Merck will expand U.S. manufacturing and provide discounted fertility treatments via Trump's TrumpRx platform. These examples underscore a pragmatic reality. Business continues to find workarounds even when governments clash. For long-term investors, this means multinationals with flexible supply chains, think Apple, Merck, and Tesla, can weather trade storms better than purely domestic players. Number 6. Canada, India, and the expanding trade chessboard. Trade tensions aren't just bilateral anymore. Canada is exploring a revival of the Keystone XL pipeline as a potential bargaining chip to ease steel and aluminum tariffs. Ontario's Premier Doug Ford warned the U.S. could lose access to Canadian uranium and potash if tariff threats continue. India, under pressure from Washington, has agreed to increase U.S. oil imports while trimming purchases from Russia, a move that may realign Asia's energy dynamics. In essence, Trump's tariff agenda has turned trade policy into a global domino effect where every move triggers a regional recalibration. Number 7. The political angle, strategy or showmanship. Calling tariffs not sustainable could be more political theater than policy shift. With the 2026 midterms on the horizon, Trump may want to show both strength and flexibility. Tough on China, but pragmatic enough to protect U.S. consumers. Historically, such positioning plays well with voters in manufacturing-heavy swing states, especially when paired with tax incentives or Buy American campaigns. However, if China retaliates with measures that hurt agriculture or tech, Trump could face backlash from two powerful lobbies, farmers and Silicon Valley. The administration already saw friction earlier this year when China halted U.S. soybean purchases, sparking anxiety across the Midwest. Number 8. Investment takeaways. Navigating tariff turbulence. Short-term strategy. Expect volatility in industrial, retail, and tech supply chain stocks. Commodities linked to rare earths and critical minerals could see speculative rallies. Defensive sectors like healthcare and utilities may outperform amid uncertainty. Long-term lens. Companies diversifying production, like Apple's India shift or Tesla's Mexico Gigafactory, stand to benefit as global supply chains realign. Investors should also watch for emerging trade alliances. The US, Japan, and Australia's coordination on minerals could create new industrial winners. ETF exposure ideas. XLI for industrial select sector, SPIDER for cyclical plays. RIT, for Global X lithium and battery tech for rare earths and energy metals. SCHD or VIG for dividend stability amid policy shocks. Number 9. The bigger picture. From trade war to supply chain redesign. We're no longer in a tariff skirmish, we're witnessing a reconstruction of the global trade map. The 2020s are shaping up as a decade where economic power is measured less by GDP and more by control of supply chains. China's grip on rare earths, the US's dominance in semiconductors and energy, and Europe's role in green tech are converging into a three-way economic rivalry. Investors who look beyond headlines towards logistics, materials, and policy-driven innovation will spot opportunities early. Tariffs are not just taxes, they're signals of shifting leverage in the global economy. The final thought is, when a president says his own tariffs are not sustainable, markets should listen. Trade policy may once again become the biggest macro driver in 2025 and beyond. As PyUncut always reminds you, volatility is opportunity, if you know where to look.